Have you ever wondered why a 3-digit number could change your life for the better or for the worse? And I'm talking about your credit score and the importance of leverage, liquidity, and control when it comes to your business acceleration. Today, we're going to talk about how to quickly build a perfect credit score. So what is a credit score? Banks require assurance of your reliability. Whenever you receive a credit card from a bank or a credit union, they'll transmit your financial information to 3 major credit bureaus, which are Equifax, Experian, and TransUnion, the tripartite division. If a bank needs to evaluate your financial history to determine your likelihood of repaying borrowed funds, they will request your credit score. This is normal. And folks, think of it like this way. Even if you were to buy life insurance, there's a thing called the Medical Information Bureau System, which does a check on your medical history. Obviously, if your medical history is suboptimal, you can't open up a bank. Well, when it comes to your credit score and you want to borrow money, you have to be able to show that you could pay your bills on time, you could pay the credit cards on time, and you're in a position where they want to give you money, not that you're asking them for money. So do yourself a favor, take a picture of this or at least study what's happening on the screen right now. This is good versus bad credit scores. And remember one thing, when they run your credit, it's a snapshot of that day and your previous history. Your score can always improve. And at the end of this video, we're going to show you that, I promise. So according to Experian, 61% of Americans have a fair Vantage score or better. But let's start with very poor looks like. And no matter where you are on this, you could always change it. Once again, it's a snapshot. But very poor is between 300 to 499 points. Poor would be 500 to 600, and people start giving credit cards there. Very, very high interest, but it's available if you just start building up your credit and put you in a different position going forward. Remember, it's a snapshot for today. Fair is between 601 and 660. A little bit of a shift that's happened over the years is good. The number on the high side is higher than normal. Good is 661 to 780, and then excellent is 781 to 850. But let's look at this. 5% are in 300 range, or let's call it very poor. Poor 21%, fair 13%, good 38%, excellent 23%. No matter where you stand on here, by doing certain things as we work through this video and taking down this information can help increase your credit score in an efficient manner if you really follow the path. So how is your credit measured? It's not all equal when you look at the pie chart here. Basically, it's weighted measurements. For example, new credit, 10% is factored into that calculation. Length of credit history, 15%. Still important. Credit mix, 10%. Payment history, this is where the big boys come in, 35%. And the amount of accounts owned or opened, 30%. So let's talk about this. Once again, weighted measurements, all are important, but remember that payment history and the accounts owned, that's 65% of the pie. So keep that in mind and understand this is what they're looking at when they do these measurements and they do these snapshots. Let's get into payment history, 35% of that pie chart. One-time payments. How many times have you missed a payment, even if it was the minimum balance? Here's the action steps that we recommend. Number 1, set up a checking account. Number 2, apply for a credit card or a secured credit card. And number 3, make small regular purchases and pay them back in full every month. Now, if you sometimes forget to make a payment, don't forget to put automatic payments on there, at least for the minimum amount, so it doesn't affect your score if you're late or if you miss a payment. These are little things, little distinctions that if you stay ahead of them, you'll put yourself in a position to not only have a better score later on, but also be able to get more money if you need it for other opportunities. Okay, folks, amount of debt, 30%. Credit utilization rate, that's the rule of thumb. You don't want to go above 30%, right? So total balance on all the cards and total available credit equals the utilization ratio. You don't want to go above 30%. If you could stay below 30% on the average of all, you're going to always put yourself in a position where they're looking at you as a solid person that pays their bills and or their credit on time. So find your credit utilization ratio. Credit utilization ratio is a significant factor in most major credit scoring models. Try to keep your ratio below 30%. So let me give you an example as you're looking at the screen right now. If you have a balance on a credit card of $3,000, but the available credit is $10,000, do the math on this calculation and that puts you at 30%. You'd like to get that $3,000 down to $2,500 because then you're below 30%. Keep that in mind when it comes to each and every one of your credit cards, not just the aggregate overall, but you want to make sure each and every one of your credit cards, lines of credit, everything you can think of is below 30%. that will not only keep you in good standing, but that'll continuously put you in a position to get more money, once again, as opportunities come your way, because you don't know when they're going to come your way. Anyway, stick to the end, because we're going to show you some shortcuts while you're building your credit up along the way. As we stick to the pie chart, let's talk about the length of credit history, which is 10% of the overall factor, and the average time your lines have been open. How is the length of your credit history calculated? Once again, here it is, folks. How long accounts have been opened, right? So then we want to look into the middle part here where we talk about how long specific types of accounts have been opened, revolving and installment, and then we're going to talk about that a little bit further, and then how long has it been since you last used these accounts. All this stuff matters, and once again, this is not a linear calculation, but it's a calculation that's based on different measurements and different factors based on what we're talking about right now. And this is according to Lexington law. So we talked about at the top, there's different percentages based on how they measure and give you a credit score. New credit is 10%. Hard inquiries, be careful with this. When you open up a new line of credit, they make a hard inquiry. It stays on your report for 2 years, and it's going to impact your score for 1 year. Here are some action items. Don't accrue a lot of hard inquiries in a short amount of time, obviously. And don't fret either, because it is 10% of your overall score. In other words, if you have, and I'm making this up, 10 inquiries, and it's in, let's say, 2 or 3 months, it's not 90% of your score, it's 10% of your score. But obviously, you don't want that many inquiries. I'm just kind of giving you a perspective. It only factors in about 10% of that overall score. Okay, credit mix, 10%. Total lines of credit. We have installment credit versus revolving credit. Installment credit has a fixed end date with payments due every month. Think of a mortgage, think of a student loan, auto loans, personal loans. And then we have revolving credit. No specific end date. Be careful of these, folks. No specific end date or set balance, minimum due each month, credit card or home equity lines of credit. So you have to understand, whenever, at least in my opinion, I'm going to give you my opinion, when you get a credit card, obviously there's no end date, right? So if you could pay it off at the end of every month, that's always a really good thing. But you always want to still keep it below 30% no matter which card it is. When it comes to installment credit, what we love about that is the fact that there is an end to it. At some point, there's a final destination. And by the way, each time you make a payment and the balance goes down, your credit score goes up, provided you're doing everything else that's right along the way. And this allows for much more fluidity, liquidity, and opportunities to excel. Okay, so now you're doing all these different exercises. It's a month or 2 months later, and you're saying, Rob, what if I still have poor credit? Nothing's happening. And I'm going to tell you right now, nothing's going to happen overnight. It is a process like planting a seed and watering it. You have to be committed to making the repairs work and following through on what your word was and being held to your own standard. You have to increase your standard and be held to it, but there are things along the way, which we're going to talk about right now, on how you can speed up this process in order to get to the outcome you're looking for, which maybe in the short term isn't a quicker or a higher credit score, but you have the funds necessary to do what you want, when you want, how you want, with who you want. If you do have poor credit and you're in the process of rebuilding, there's other things that can happen right now that could accelerate that. In other words, if you learn how to become your own bank, which is where we sit down with folks that are working on their credit, but at the same time, in the future, not want to rely on credit scores, although it's good to have great ones, building your own bank through a cash value life insurance policy is a strategy where not only do you overfund it early and often, you stay within the rules of how that works, and then you can leverage that money to go buy real estate, finance your own debt, whether it's cars, whether it's hard money lending, whether it's equipment. And by doing this, you're going to earn a rate of return not only in your policy, but also the interest that you would have given that bank for that same credit score. You now, or that line of credit, you now get to give yourself that interest by utilizing the cash value life insurance plan while you're building up your credit. So anyway, if you want to learn more, go ahead and click the link below. One of the team members here at Epic is going to take you through the success process and share with you strategies on how you can accelerate your money time freedom, not only in becoming your own bank, reiterating how to increase your credit score, and giving you the education you need to make good decisions. So thank you for checking us out. Continue to follow, like, and subscribe, and look out for the next video that's coming after this.